started. So let's look into some details about the financial reports. First off, we got the cash flow statement, which reports on the cash received and paid. Overall, it tells us the firm's cash balance at the start, the changes that occur, and also the final balance at the end. We also have the income statement, which reports on the revenue earned and the expenses incurred over the reporting period. And lastly, something you should be familiar with by now, is the balance sheet, which reports on the assets, liabilities, and owner's equity at a particular point of time. So, calculating profit is done by doing revenues take away expenses. Now, what is a revenue? As before, I've broken it up into three parts to help you out. So, revenue is an increase in an asset or a decrease in a liability. That overall increases our owner's equity. The only exception to the rule is capital contributions. While an expense is a decrease in assets or an increase in liabilities, that overall decreases owner's equity. The only exception to this rule is drawings. And profits are merely the records of the net increase in owner's equity, calculated through the deduction of revenues from expenses as a result of the operations. So let's try to figure out some revenue tickets. So we got cash fees, credit fees, interest on bank, commissions made on sales. These are all types of revenues. While receipts from accounts receivable, capital contributions, loans, and GST received aren't forms of revenue, because each one of these right here does not cause an increase or a decrease. Well, actually it does. It probably can cause an increase in assets or a decrease in liabilities, but it doesn't overall change the owner's equity section. Because it fails to do part 2, it is not a form of revenue. And here are some expenses. We've got wages, electricity, interest on loan repayments or mortgages, depreciation of assets and bills. What are not expenses? The purchase of materials, payments to accounts payable, mortgage or loan repayments, GST settlement, GST paid, purchase of non-current assets, and drawings. Why aren't they included? It's because they fail the second part of the requirement. They don't overall decrease owner's equity. So cost of sales. Cost of sales is an example of an expense because it's an outflow of economic benefits which overall reduces our owner's equity. Cost of sale doesn't result in an outflow of cash. You will not find cost of sales on your journal. You will need to rely on your inventory card for that value. Cost of sales is determined by adding together the values of each sale recorded in the out section of the inventory cards and deducting the value of each sales return recorded in the in section of the inventory cards. I'll show you an example later. So here you go. Here's an inventory card. Just remember, each inventory card records one particular stock item. So you might find you have a few different inventory cards that account for the movements of that particular stock item. For example, at Bunnings Warehouse, I went past it today and they said they have over 20,000 products online. Now, in store they might have over 30 or 40,000 products online. Oh, not online, in the physical store. So imagine having that many inventory cards for each individual item. It's quite painstaking and long. So in order to calculate your cost of sales, we go to the out column and just add the totals from anything that says receipts or anything that says invoice. So in this case, what happened on July 12th and what happened on the 23rd of July are prime examples of cost of sales. So how do we calculate the total cost of sales? Well, with each inventory card, you add up the cost of sales, and then together, every single one of those cost of sales, you add them up to figure out your total cost of sales. And here's an example for you. We got the Yoki Hemo tires, the Great Year tires, the Bridger Rock, and the Mitchelton tires. Altogether, our cost of sales for the period was $5,345. So using this information, let's try and create an income statement. Okay, so now we got the basics of revenue and expenses out of the way. We can now use what we previously learnt, add what we've learnt today, and use them in conjunction together in order to develop an income statement. So just for your convenience, I left revenues and expenses definition right here for you. And here is a journal that you guys are familiar with by now. So just judging by this, what we normally do is we should get a whiteboard marker I wonder if I have one here. Oh, there you go. And you should start circling or ticking off. Actually, I prefer you to circle it. Circle all the items that you think are revenues and circle all the items that you think are expenses. Now, I've already circled the stuff in green as revenues for you and the stuff in red as expenses for you. Just remember, guys, if it doesn't overall increase your owner's equity, then it's not a revenue. If it doesn't overall decrease your owner's equity, then it's not an expense. You need to use that accounting equation to help you out. And you guys should be pretty familiar or pretty comfortable using the accounting equation by now. If not, I suggest you refer back to chapter 2 and relearn these concepts. So once you figure out what your revenues are and what your expenses are, this is how you create an income statement for a trading business. So let me go through this. You got your cash sales, which is located from right here. Next, you got your credit sales, which is located from my sales journal, because these are all sales that were done on credit. You add those two together, we got $56,200. Less our sales returns of $1,800. Where did we get that sales return from? That sales return came from over here. So whenever customers return items, we have to record it as a sales return on here. So we have to take sales returns away from our total sales, and that gives us our net sales for the period, which is $54,400. Now, net sales literally tells us how many sales we made during that time frame. So what's different under an income statement for a trading business is the fact now that we have to account for cost of goods sold. So this is a new title that you have to include in your income statement. And under cost of goods sold, we have to record items which are associated with selling the object. Sorry, with our cost of goods sold, we have to record any costs associated with getting the products ready for sale. In this case, the inventory itself has to be recorded here, or the inventory that we use during that sale has to be recorded here, and any costs associated with getting it ready for sale. In this case, we have to pay delivery to bring the stock into the store, so it has to be included as part of our total cost of goods sold. In this case, these are the two items. Now remember, the first column is always used for adding stuff, and the last column is always used to give us a grand total. In this case, our grand total of cost of goods sold is $32,000. Now what we do after that is figure out our gross profit, and that's calculated by our net sales take away our cost of goods sold. You take away these numbers from each other and you got $22,400 as your gross profit. Once that's determined, the next step involved is to figure out our adjusted gross profit. And this is where you put in your inventory lost or your inventory gain into the equation. So since we've lost inventory, as stated previously, over here, I do apologize, it showed we had $12,400 worth of stock, but inventory in hand was meant to be $13,200. The difference between these two is $800. So we lost inventory of $800. Since we lost $800 worth of inventory, we have to take it away from our gross profit. So in the end, our adjusted gross profit is $21,600. This tells us how much money we have, how much revenue we have made just purely after accounting for the cost of selling the goods. After that, it's pretty basic, with just less other expenses. So all the other stuff that we've highlighted, like advertising, interest on the loan, delivery to customers, these values here are located here. Alright, just remember, interest on the loan is an expense, but a repayment of a loan is a liability being reduced. So it's not a form of expense because it doesn't overall decrease our owner's equity. So one more time, interest on a loan goes into an income statement, repayment of a loan does not. Anyway, we add up all our expenses together and give us a grand total of $8,400. In the end, to figure out a net profit, we simply have our adjusted gross profit, take away our expenses to give us a net profit of $13,200. So next up is a cash flow statement. this is the thing I tried to show some students in class just yesterday. So an accounting report that reports all cash flows during a reporting period classified as operating, investing, and financing activities. Operating activities involves cash flows related to the day-to-day activities of the business, while investing activities record the cash flow related to the purchase and sale of non-current assets. Lastly, financing activities are cash flows related to the changes in the financial structure of the firm. If you haven't written this down yet, I highly suggest you do, because this is a great cheat sheet or notes to take down to help you remember these concepts. So using the information, let's create a cash flow statement. So how do we use these journals and determine what belongs in a cash flow statement? Well, if you follow these little guides here, you should be able to determine that you only need a cash receipts and a cash payments journal in order to do a cash flow statement, because they're the only two that relate to cash. Next, we need to categorize everything from the cash receipts journal and the cash payments journals into one of these three activities. So first off, work your way through the top columns. So sales. Sales we know is part of day-to-day operations, so it'll be an operating inflow. Receipts from accounts receivable, operating. GST is always operating. So whenever you see GST, just remember it always goes in operating. So we have one item in the sundries, and we cannot put sundries in a cash flow statement because it's too broad of a statement. We have to look at the individual item and figure out where they belong. So in this case, the sundry is the loan to Bank of Guam. Since it's a loan, that's part of the financing activities because it changes the financial structure of the business. So in the end, these are all our cash inflows, and these are all our cash outflows. So let's try to categorize them. So freight in is a part of the day-to-day activities, so operating. Advertising is part of operating. The loan is part of financing because we're repaying the loan, so that's outflow of cash. Interest on the loan is operating. Now it's very easy to confuse interest on a loan and a loan repayment. Just remember, interest on a loan is an expense. It's also part of your day-to-day trading activities. Delivery to customers is also part of your operations. Inventory is part of our operations. Drawings is part of finances because the owner is withdrawing money from the system. Wages is part of your day-to-day expenses. And our GST is part of our day-to-day expenses. Remember, we cannot just put sundries on its own. We have to look at the individual items in the column and record them as each individually. So once you got that information, it translates into this cash flow statement. Now last class I partially did one and show you how to do the cash flows from operating. Today you get to see the rest of it in action. So first off, we need to record all the inflows from the operating activities, like so. And then put the grand total on the far right. Next, when it comes to outflows, just remember to put brackets to signify everyone who's reading the report that there's money leaving. So in this case, inventory, wages, GST paid, freight in, advertising, interest on loan, and delivery to customers are all operating activity outflows. Add them all up, and that's our grand total there. The net cash from operations is literally the inflows take away the outflows, and it gives us this total here. Next, we got to record cash flow from investing activities. And luckily enough, there is no investing activities occurring here. There hasn't been a purchase or a sale of non-current assets. So this section is left blank. And lastly, we got cash flows from finance activities. Now, the only inflow that we received during this time was the loan that we took out from the Bank of Guam. And since it's only one line item, and it forms a grand total of inflows, we just record the value on the far right. Now, drawings and a loan are cash outflows, and they have to do with finance activities. So we have to add those two together to give us a grand total of $5,500 in cash outflows. In the end, our net cash from finance activities is the $5,000 take away the $5,500. This gives us negative $500. The next step after you've done each individual category is figure out the net increase or decrease in the cash position. And that is simply by adding all the net cash flows from each section. So in this case, we add this, with this number here. So in the end, we should have 13,860 as our net increase in cash position. Now the bank at start is $10,600. How did we get that value? Well, it's located up here in the information about these journals. It's important that you guys read all the information that's made available to you during any activity, because it's very easy to miss something like this and make a careless mistake in your reports. So in the end, to figure out a cash or bank balance at end, we simply just add our new cash position to our bank balance at start to get our final bank balance.